Hello and welcome once again to the Smart Money Dumb Money Show. I am your host, as usual, Keith Richards. I am President and Chief Portfolio Manager at Value Trend Wealth Management, and I'm a technical analyst. And today I have some good news for you. Those of us who have been a little bit dismayed by the rather parabolic move by, for example, the Mag 7s and many of the other tech stocks out there, take heart because there is some research I'm going to show you today suggesting that we are moving out of that parabolic move on the tech sector and spreading the love by seeing some of the other sectors out there picking up after a year or more of drudgery. And this is good news for the market. And I'm going to show you, as I said, some evidence to why those of us who prefer a broad-based market breadth type situation will likely be happy to see a more orderly market coming soon to a theater near you, as I like to say. So we're going to go into a PowerPoint, and I want to just show you the setup, and then I want to get into the backdrop to the breadth. So let's share screen with a little bit of a PowerPoint, as I said, that I put together. And I want to start off with a quote. And really, my concern with the Mag 7s, and really the Mag 7s are the Mag 6 now because Tesla has kind of fallen off the map. But my concern with the tech sector in general is that they have, as a group, moved parabolically. And famous technical analyst Bob Farrell, if you don't know who he is, you should look him up because he is one of the granddaddies, one of the greatest technical analysts who's ever lived. Unfortunately, he passed away a while ago. And Farrell said that parabolic advances go further than you think, but unlike a more orderly advance, they don't correct sideways. They almost always correct in a very nasty fashion. So another technical analyst, and I'm forgetting his name, and I apologize, he noted that fighting a parabolic uptrend is akin to stepping in front of a freight train. As he notes, though, that even if you want to step aboard the train, it can be equally dangerous. So let's take that concept and take a look at some recent parabolic examples. Now, these are commodities, and I want to highlight the moves of these commodities that happened just after the COVID crash. You guys might remember the supply chain problems where you wanted to build a house or you wanted to, eat. A lot of the commodities that were used in the production of our day-to-day products and services that we rely on in our economy went through the roof. I'm sure you people remember that. It was kind of a in-your-face situation when, we went to, as I said, build a house, buy a car, whatever it was. So as you can see, the classic one was lumber. A lot of people talked about lumber. That was on the right-hand side of the chart. You can see the spike and the drop. Again, parabolic rise, followed by not a nice consolidation period, but a outright crash. You can look at the other three commodities, wheat, corn, nat gas, all spiked hard, fell hard. I'm currently looking at nat gas, as you've probably seen on a couple of my recent blogs and videos. But whatever the case, these are good examples of Bob Farrell's rule that parabolic moves do not end with nice, orderly sideways periods as they catch up to an orderly trend line. So with that in mind, let's take a look at historic moves, even on the stock market, forgetting individual security moves. A couple I want to point out, I put the little happy face person there, meaning that they're irrationally exuberant. They're so excited, they're piling in on these trades on the market. And you can see, if you go back to before 1987, for example, everybody maybe is aware of Black, what was it called? Black Friday? It was Black Monday, actually. Sorry, I'm thinking about the shopping season. Black Monday, October of 1987. And leading into that, notice the angle of ascent on the market. All right. So often you get these high angles of ascent. So there's a nice early move in 2006, 7, and prior to that, and then a hockey stick move up. I like to call it the hockey stick move. It's like the end of a hockey stick. There was an uptrend, but then it arcs. And that usually involves with a crash. There is the COVID crash, but you'll note that leading into the COVID crash, and you might remember everybody was talking about the FANG stocks, which some of which are included today in the Mag 7s. Not all of them, Facebook is not. Let's take a look at another correction that we've seen lately, which was 2022, another hockey stick move up leading into that. Well, what do we have on the right-hand side of the chart? Today, we're recording this late March 2024. Well, we've seen a bit of a hockey stick just over the past few months. If you look at some of the leading stocks, and we will in a second, you'll see what's driven that hockey stick. So we had a relatively orderly year in the year 2023, but now we've got a hockey stick happening. Remember Bob Farrell's rule: whenever there is a parabolic move, it rarely corrects sideways. Okay, here's the move. So this chart doesn't really show you the extent of the move. So I put a percentage return indicator, which is the right-hand indicator. It's a tool you can use on stock charts just to measure the move between the bottom of this move, basically late October of 23, into current, which is roughly I think we're the 24th of March as I record this. You can see there was a 30% move on the Mag 7, and this includes Tesla, which actually held it back. If you looked at NVIDIA and them, you would see that this move was actually more than 30%, subtracting Tesla out of the equation. So this is the MAGS ETF. It just represents those 7 stocks as a group, all right? But really, that move has been more than 30% in just 4 months if you took Tesla out. This is a parabolic move, all right? So we should be worried about that parabolic move, but here's the good news. Of late, now this is a 2-month relative strength chart. So I'm looking at 44 actual days of trading, which is typical per month. You get about 22 days of trading days built in, and the other days are weekends. So if we look at 44 trading days, roughly 2 months, you will see over the past 2 months, technology has been an underperformer. When this chart shows a negative, it doesn't mean they've lost money. It means that the technology stocks have underperformed the baseline, which is the S&P 500, by about 5%. All right, all things considered. So if the market made 10, they made 5, sort of thing. They underperformed by about 5%. What's been outperforming? Well, good old-fashioned industrials, the boring industrials. Materials, this is copper mostly, but other metals. Energy, oil stocks have gotten a bid for the first time in a long time. If you look at energy and materials in particular over the past, say, 6 months or 12 months, you'll see they were the dog's breakfast. And even some of these other sectors that are not especially outperforming the market are nowhere near as bad off as technology. The only one maybe as bad off or worse is real estate, but we'll discount that. And we'll just look at the main sectors of the real estate or of the market, and that is a pretty decent distribution, and in fact, some real strong outperformers, and everything but technology seems to be working. So that is good news. Well, why is it good news? Well, we're seeing rotation into other sectors. Here's a little bit of statistics coming out of sentimenttrader.com. And I like Sentiment Trader because they're pure quants. They do sentiment work, but everything they talk about is backed by data. And data, you know what they say? That charts don't lie, and you can only trust what's in front of your eyes, so to speak. So the equal weight version of the S&P has so far had a 1-year return of nearly 20% less than the cap weighted, based on all those tech stocks. And that's a very wide spread. In fact, it's the widest spread, the widest underperformance by the equal weights since 1958. However, as they note here, and you just saw on my performance chart, that there are some signs of reversing. It's been only 2 months, but 2 months is 2 months. It's not just been a week, it's been 2 months that we are seeing breadth pick up. And that's good news. Similar behavior happened only a few times, but it preceded future outperformance, and here's the key words, of the average stock. So in other words, if you're not just piling into that one sector and you don't feel comfortable piling into that sector, I don't, then it's nice that we should be able to look forward to performance by other stuff. Isn't that exciting that it's not just one sector that we should be invested in? Common sense, asset allocation, all that stuff is going to come back to the markets. Hooray. So I just wanted to present this short show to give you hope that if you're not enamored or succumbing to the pressure of buying into the tech sector just because everybody else is, well, perhaps your time has come. Perhaps now it's time to start buying other sectors as the market rotates out of tech, as we clearly saw is happening over the past 2 months, and into recently and previously overlooked sectors. Thanks for watching, and we'll catch you next week.